Hello friends, I welcome you in my another video on the performance indicators of bank. This is part 2 video, and in this video we are going to discuss about the indicators which are related to income and expenses of a bank. Okay, so this is the format of the balance sheet because here we may require certain items for a reference, so that I have that is why I have taken the format of balance sheet, and this is the format of profit and loss account of the bank. Okay, so friends, as I have mentioned in my earlier that part 1 video, that the format of balance sheet and profit and loss account of a bank is governed by the Banking Regulation Act, and the commercial banks are supposed to follow the format prescribed by the Banking Regulation Act. Okay, and as per the recent development, now this disclosure requirement is also now applicable on the state as well as central cooperative banks. Okay, the Reserve Bank of India, they have issued the recent direction with respect to applicability of disclosure requirement for the state and central cooperative banks. So, in the series of this income or expenses related this indicator, first is the interest income. So, interest income as a percentage is always calculated on the average weighted fund. So, what is the average weighted fund? We have already discussed in part one. So, as we know that for a bank, the interest income is the primary income. Okay, so in other word, we can say this is a sales of a company, though there is not actually sale, but the interest is a main income or a primary income of a bank. Okay, so that's why interest income as a percentage of average weighted funds, it gives the overall strength when we compare it with other bank or a peer banks or as an industry. Then it gives an indicator how the bank is performing or how the bank is generating the income on the total average working funds. Okay, so interest income is basically the sum total of discount, interest income from loans and advances, interest income from investment, interest income from balance with Reserve Bank of India, and other interest inflow is total interest. Okay, so friends, here we can mention that here we are adding all the interest income because whatever the investment banks, the commercial bank, they do, this is as per the direction given by the RBI, so they are not free to invest their fund anywhere. Okay, so that's why when the interest income is considered, the all income, okay, so the sum total of discount, interest income from loans and advances, even though investment income also, and the balance with RBI. Okay, so balance with RBI we also take into consideration. Okay, so now as far as the banks are concerned, all interest income are policy. So that we have already mentioned, since it is governed by the policy or direction of Reserve Bank of India. So that is why we always take all kind of invest interest income, including the interest on investment. So this is the ratio. If it is higher, the percentage higher the ratio, so better the performance of a bank. Then non-interest income. So non-interest income basically includes such the exchange commission, brokerage, gains on sale and revaluation of investment and fixed assets, and profit from exchange transactions. So friends, as we know, other than the interest income, a bank do many activities like locker or insurance business for third party products. So this is the non-interest income. Okay, so this ratio denotes a bank's ability to earn from non-conventional sources. In a liberalized environment, this ratio assumes greater significance, for it mirrors banks' ability to take full advantage of operational freedom. Okay, so though the primary business of a bank is to accept the deposit and lend the money for the to the needy people, but however there are n number of avenue available as per the direction given by RBI. So bank can utilize their average working fund in the best possible manner to earn this non-interest income. Okay, so it also one of the indicator which the bank is required to disclose in their financial statement. So it is again, as we are talking about the income, so higher the percentage, better the performance. Then operating income. So what is the operating income? Operating income means total income minus non-operating income. So operating income means the income which is generated through the normal operation of a bank. So like for a bank, the interest income is a operating income. Depreciation or like depreciation is a operating expenditure, but like commission, brokerage, these are the example of operating income. But other like non-operating income, when we call the sale of fixed assets or sale of investment. Okay, so these are the example of non-operating income. So when we deduct the non-operating income from the total income, we get the operating income. So operating income is also indicator of how the bank is performing through their operating activities and how much the operating income is generated on the average working funds. Interest spread. So spread, what is the spread? For average, so spread is equal to average yield on advances. It means the interest rate on advances. Okay, and less or minus average interest rate on the deposit. So the gap or the the difference between the rate on advances and rate on deposit, it gives us the spread. So this is the basically the profit margin for the bank. Okay, so the greater the spread, the more profitable the financial institution is likely to be. The lower the spread, the less profitable the institution is likely to be. In simple terms, the net interest is spread is like the profit margin. Okay, so this is another financial indicator where we talk about the spread. Okay, so the spread gives us the basic idea how much there is a cushion. You can call it as margin or margin of safety for a bank. So if this is the the greater is the percentage, the more profitable the organization or the bank is. Okay, so anyway, when we always when the ratios are compared, it is either between the two period or the two peer banks or with the industries. So when we compare one ratio with either another company or with different people, then we have a certain meaningful expression of the same. So interest spread is also one of the disclosure requirement as suggested by RBI. So this is the methodology, and higher the percentage, better performance of the bank. Then interest expenses. So now, after having the discussion for the income side, now we talk about the interest expenses. So as we have already mentioned that for a bank, it is it is the interest expenses on the deposit, which is the main source, main primary source of expenses, because the bank, they get the deposit, and against those deposit they lend the money to the borrowers. So interest expense on the income statement represent the interest accrued during the period covered by the financial statement. So this is so as we know now, everybody follow the accrual basis of account. So it is not the actual interest paid, but the total interest accrued on the deposit. Okay, the amount of interest expenses has a direct bearing on profitability, especially for the banking companies with a huge debt load. Okay, so the debt or the deposit is like the kind of debt only for the bank, though they accept as a form of deposit, but it is a debt for a bank. Okay, so interest expense, whatever the amount is being expended through the interest expense, it gives an indicator how much the bank is spending compared to other banks. So the lower the percentage, the stronger is the ratio. Okay, so again, when we compare the interest expenses of A bank with B bank, then definitely the bank who is having the lower percentage of interest expenses, it means they are they are in a better percentage to they are in better position to sell their deposit and earn the income through the advances. Now, operating expenses. So it includes expenses like establishment expenses, rent, taxes, lightning, printing and stationery, advertisement, publicity. So basically, all expenses which are required to be incurred in day-to-day operation of a bank is considered as operating expenditure. So what are the non-operating expenditure? Non-operating expenditure are like sale on loss on sale of fixed assets, which are non-operating expenditure for a bank. Okay, so comparison of operating expenses ratios are generally most meaningful among banks within the same model, and the definition of high or low ratio should be made within that this context. Okay, so basically, definitely, if I'm comparing the A bank with B bank, so definitely they must be having the same business model. Okay, so I cannot compare the indicator of a payment bank with a full-fledged commercial bank. Okay, or as cooperative bank or NBFC with the commercial bank. So the business model has to be same. And again, so when we talk about the average working fund, so it is always because these are the fund available for the bank as a working fund. So we calculate this ratio against the average working capital fund. Okay, so the lower the percentage, better performance of the bank. Then operating profit. So operating profit is equal to net profit before provision contingency and excluding non-operating income and non-operating expenses. So friends, we have already discussed what is the non-operating income and non-operating expenses. So this ratio relates bank's operating profit with its average working fund. Okay. So anyway, all the ratio which we have discussed, it is based on our is calculated against the total availability of average working fund, and the profit from operation is very much important as well as its percentage to average working capital working fund. Okay, so the bank are supposed to earn the income through their normal operation. Okay, so other income they are free to do other business, but that is the main business of a bank to generate a operating profit, a sufficient operating profit through their operation. Okay, so again, the same thing, if we compare this with the same business model of two banks, and one bank which having the higher operating profit compared to other bank, then definitely the bank which is having the higher operating profit is considered to be strong and in a better position. So again, the higher the ratio shows higher profitability of a bank. So friends, with this, I have concluded my second video on the financial indicator of bank. Hope you like it. And the intention is just to have you the understanding of the other ratio, which normally it found there is place in the balance sheet of a bank, but nobody talks in a general sense. And it will definitely give you some concept clarity on the this calculation as well as the basic concept of this ratio. So thank you very much.